Hi guys, so in this video we're going to be talking about equilibrium, and that is basically the 50% mark of any range, and we'll also go a little bit about OTE, but I don't really use that a lot. But basically equilibrium is just when there's a range, there's always going to be a top part and a bottom part, with the top part being called premium and the lower part being called discount. Premium just means that it is expensive at the moment, the price is expensive, and discount means that the price is cheap. When price is in discount, you would expect it to go up because it's unsustainable, right? It's not in the middle point. And when price is in premium, you would expect it to go down. So this is something that you guys can use to form part of your context for you guys to get your bias for the day. But this is definitely not just a confluence, or not your whole trading strategy, or not my trading strategy at least. So that's just part of something that I use to form my context and for me to see where price is at, for me to see what prices are probably likely to do next. So the difference between an uptrend and a downtrend is that when you are measuring the equilibrium from an uptrend, you want to measure from the low to the high, from this low right here to the high right there. And I didn't even do this on purpose, but it just lines up right there with the equilibrium. So you want to make sure that price enters an equilibrium of that range before continuing upwards, because it's an upwards range, right? And for the downwards ones, you want to go from the high to the low. So from this high right here to this low. And you want to make sure that price either taps equilibrium or goes into it. Wow, it just lines up perfectly. So it taps into it or goes into it before you go down. This part is called premium, right? So when it's going upwards, you want it to be in a discount because you want to buy. When it is in an uptrend, you're looking for buys. And when you're buying, you want to buy in a discount because you want it to be cheap. And when you're selling, you want to sell in a premium because you want it to be expensive when you're selling. And you want to sell so that it goes to that discounted price and then you can buy it back. That is how it works in terms of equilibrium. So you want to go measure like that. So we'll just look at some live examples right here. This is probably going to be a really short video because this is something that you guys can use for every single time frame, and especially for daily candles and even for candles as well. You guys can look at daily ranges or weekly ranges and look at where equilibrium is. And even for like fair value gaps, some people look at some people measure a fair value gap and they go take the equilibrium box and measure from this to this. Even that, you can just measure an equilibrium box of that, and you can just measure equilibrium boxes of pretty much anything, but make sure that it has to make sense. Like, don't just measure anything. Actually, here we got this range here, right? This full range, and something that I have been targeting is for it to go back into equilibrium. See, this sell side liquidity lines up perfectly with this equilibrium, which is what's something really amazing about the market. Sometimes it's just that like levels line up and it's just really amazing. So here we can see we were in an uptrend, right? We're in an uptrend right now, and we just created this high right here. We pushed past this and we created this high right here. So now what I want to do is, as it retraces here, as it goes back in, I want to see where the equilibrium is, which as I measured from here to there, the equilibrium is here. It's the midpoint there. So that is at this sell side level here. So when price enters this sell side level, I can start looking for buys, or I can start looking to see if market wants to change to become a buy. Obviously not as soon as it touches here, then I'm going to look for a buy because this is a pretty high time frame, but we'll talk about that in other videos. But another thing that you can use equilibrium for is that now that it's very obviously in a premium, we can also see if market structure is bearish on lower time frames and sell, which is why I sold here. And which is why today I'll probably likely be looking for a sell as well, because we're in premium of the range of this high time frame range right here. So we'll just go over this range right here and to see equilibrium play out. So another thing is why I don't only use equilibrium is because you don't always need to tap equilibrium for it to go down. If we're in a really heavy selling environment, sometimes it just doesn't. So here, for example, it doesn't go back. For it to go back to equilibrium, it will only be to sort of rebalance the price action, and sometimes if price is already balanced, then it would just not go back up. So example where I think it did tap equilibrium is probably here in this range. We tapped equilibrium before continuing downwards. Not really tapped, but also almost. And in this range as well, we tapped equilibrium before going downwards. So that's why equilibrium can be used as one of the things that you guys can take into account But there's also a lot of other things as well that determines whether price is going up or down, or whether price is expensive or not, or whether price has enough sort of fuel to continue upwards. Like other things like liquidity, news articles, volume determines whether price wants to go up or down as well. So equilibrium is really for you to just be part of the context and for you to see whether price is expensive or cheap at that price point. So it's not really like a confluence for a trade or anything. It's just part of the big picture. I'll see you guys in the next video, and I hope you guys have learned something out of this. Bye.